no policy rate cut, no repo rate cut?
No repo cut, but there is an SLR cut. That is the big surprise. From 23%, SLR is reduced by 0.5% to 22.5. I expect yields are going to rise immediately on government bonds. So watch the government bonds. Another important change is that the amount of money available under export credit refinance from 50% of eligible export credit has been brought down to 32% of eligible export credit, which means for the system as a whole, 20,000 crore rupees less is going to be available under export credit refinance. But that is being made good by increasing the repo amount, the amount available under special repo facility by 0.25%. That is 20,000 crores will come back into the system through repo. So a special 20,000 crore available under export credit facility is being cut off, and that 20,000 crores is coming generally to the system through the form of the special repo facility. So the amount in the repo is increasing by 0.25% of the total deposits in the system. The other important changes is the document tone is slightly dovish, and I will come to it in a minute. Before that, okay, let me read out that to you. Why am I saying it is dovish? See, the Reserve Bank says at the moment their year-end inflation expectation is 8%, consumer inflation. But however, note this sentence. The Reserve Bank remains committed to keeping the economy on a disinflationary course, taking CPI inflation to 8% by January 2015 and 6% by January 2016. If the economy stays on this course, further policy tightening will not be warranted. On the other hand, if disinflation adjusted for base effects is faster than currently anticipated, it will provide headroom for a further easing of policy stance. I mean, they could have said that if inflation increases, we will raise rates. If it falls, we will cut rates. But they have not chosen to say that they will raise rates. They are saying that they expect the inflation to remain in the trajectory that they predicted, 8%. Therefore, no change in rates. But if disinflation were to gather pace, that is adjusting for base effects, if disinflation is faster than anticipated, then there can be headroom for easing rates on the policy stance. So to me that looks like a minor dovishness, that's all, not major. Otherwise they have not changed the growth forecast. There are a couple of procedural easing, that is FIIs could trade in currency derivatives up to the extent of their underlying exposures. Now they can deal in currency derivatives to the extent of their underlying exposures plus an additional $10 million. So there is more FII activity invited into the currency derivative space, and that facility is also available to domestic entities. So, I mean, just watch MCX and these kinds of shares. There is going to be more currency activity, basically derivative activity in the currency market. Watch the rupee and watch especially shares like MCX or anybody who is running a currency exchange, because there is more volume of activity coming in the currency derivatives market. And then one small consumption, consumer-oriented easing, advantaging people like Sonia, maybe who travel abroad frequently. Until now, you could take out $75,000 without giving any reasons. Now you can take out $125,000. You know, this used to be 125,000. It was brought down to 75,000 last August when there was a supposed run on the rupee. So, and we all called it capital controls are back and stuff like that. Now all those are off. So it really shows that the Reserve Bank is so damn confident about the value of the currency and its potential appreciation. So that again is an easing of the amount of dollars that you can take out of the system. As well, you can take out 10,000 rupees from the system originally that was available to citizens. Now it is available even to non-citizens. But that I would assume is minor. The important point is SLR cut and export credit refinance cut, which is compensated by an increase in the total repo facility by a same amount. So let me go straight away to Mr. Mundra, if Mr. Mundra is with us. Sir, this 0.25 reduction in the SLR and the export refinance, do you think the credit available to exporters will become expensive?
See, it's like this number. As far as the SLR cut is concerned, I think clearly looking forward to the expectation of revival of industrial activities and the expected increase in credit demand, probably is releasing some more money for the banking system. to divert toward the credit. As far as the export refinance is concerned, I think the whole endeavor gradually is to bring all these facilities under a one kind of umbrella, and which can be more related to the market rates, and so that the yield curve is also. So I think it is an effort in that direction. If you look at it, liquidity is maintained at the same level, components are shifted. So I think there's quite the step in the right direction.
Yeah, actually, sir, the RBI even says that they don't want the specialized credit for exporters and any other sectors. They generally want the entire system to be able to access money. So that is the purpose for which the export credit refinance has been reduced. But I'll come to you in a minute, sir. Let me get to Anant to just check how the market will read it. Anant, SLR cut. And as well, that will mean banks can lend a little more. How will this impact government bond yields? How will this impact corporate bonds? Will there be a little more money in corporate bonds?
This was clearly out of syllabus, Lata, to that extent. But having said that,
yes,
at the moment, clearly given that the credit offtake is pretty low at 13.6%, there are surplus funds available with the banking system to deploy in government bonds. Overall, yes, I agree with Mr. Mundra. I think this will make money available for the corporate sector on an overall basis. But given the fact that we still have FI demand for government bonds, given the yield's attractiveness, I think overall the impact in the short run should not be too much. Over the course of the year, we'll have to see how this trend continues, Lata. So at the moment, maybe 4-5 basis points sell-off, then the market will take a breather. There still is demand for bonds, both from FIs and banks. That doesn't go away.
Okay. Actually, I want to come. Another expert joins us. Shilpa Kumar, Head of Treasury at ICICI Bank, joins in. Shilpa, your first thoughts on the SLR cut, as well as on this export credit finance. How do you think government yields will move? How do you think corporate bonds will move? How do you think interest rates to corporates will move?
Yeah, good morning, Lata. I think RBI has been talking for a while about SLR cuts, and I think this is really a first step at probably what they saw as an opportune time to get it done, because in a sense credit growth is yet somewhat slow, expected to pick up. So in a sense, reducing the preemption of money, making more available for credit in future when the economy picks up. So in a sense, I guess it was timing an event which had been talked about for a while by the RBI. I think the initial reaction on the bond market side might be a little bit negative, but given the fact that at this point in time credit is slack, also given the fact that there is interest in our bond market at this point in time from global investors, I think this would eventually balance out the somewhat short-term negative response to this event.
Okay. But doesn't this leave you all a little more money for banks? You have to put less in SLR, and to banks like you all who run a tight ship as far as Treasury is concerned, it gives a little more money in your hands. Plus, export credit refinance has been replaced by the repo facility as well. Even that can be accessed more judiciously. Do you see any trimming of interest rates at all, either in clean loans given to corporates or in corporate bond yields? I mean, is money getting cheaper even by 5-10 basis points for companies?
Yeah, I think at this point, structurally not that much has changed, Lata, from a rate point of view. I would rather say the structural change has been much more from a form point of view. So especially if you take a look at what's been done on the export refinance, again, they've kind of quoted the Urjit Patel report to say they're staying with their recommendations of moving away from sector-specific lending. And hence, in a sense, it's actually going down the path of continuing to push the wholesale market towards taking a view on and bidding for term repo and developing the term repo market. So I would say it's part of that structural move much more than anything else.
All right. Finally, Shilpa, that statement which Sonal and others have been discussing, even Dr. Rangarajan, this small mention that if disinflation were to happen faster than currently anticipated, there would be room to cut rates. Do you expect this to have a shadow of dovishness on the market? Do you see, after this knee-jerk yields rise, you think this is going to have a softening impact on bond yields, and bond prices are going to pick up because of this?
No, I think bond markets will definitely take, heart from this comment. But really, for any significant move on the bond yields front, I think everybody will be looking out for some action from the government side, because really, in our view, and I guess most people will think the same, a significant change in the inflation trajectory can happen only when there is government action on very many fronts. Okay. So I think really what everybody will look for is the vision of the new government and how that pans out in the budget that they will present in the coming month.
All right. Okay, Shilpa, so you don't see at the moment any chances of interest rates or any easing of financing conditions at your end?
I think, see, these are things which are influenced not just by a change like this. They're influenced much more by the demand, supply for money which is going to happen. So all of those factors really need to be taken into account for a change in interest rates. So at this point, one would really need to watch for those.
Kundra, what's your sense? After this policy, because of this policy, you're not going to change or trim any of your rates? You're not going to invest a little more in corporate bonds or corporate investments?
Lata, I think if I may say so, number one, what you were mentioning about whether the, hawkishness of the policy or dovishness of the policy, I would rather say it reflects more the consistency of policy. I think that would be the right way of looking at it. Because if you look at all the three major components which we have discussed today in the last few minutes, number one, about the CPI linkage to the policy rate, very clearly articulated, maintained. Yes. The SLR coming down, which is a medium to long-term goal, as well as provide the credit opportunity, and also the removing from export refinance and taking it to the policy rate, so that there is a secular yield curve which is developing. So I would rather like to say that it is more a consistency of the policy. That is how we need to look at it. See, as far as I don't think there is a direct correlation, as Shilpa was also mentioning, that yes, there is a SLR cut to some extent and it gets translated immediately into the any policy rate cut, because essentially demand and supply, the rate which we are required to pay to the depositor. So I think it will be more, we will have to see for some more time how the trajectory is coming, and then a view can be taken.
Short point, no change in any rates at the moment for you.
Yes, if you like a short point, that is what it is.
All right.